Open this hearing of the House of Representatives Standing Committee on Economics for the review of the Australian Prudential Regulation Authority Annual Report 2023. This morning we'll hear from representatives of APRA, and this afternoon we'll hear from ASIC. In accordance with the committee's resolution of 9 August 2022, this hearing is being broadcast on the Parliament's website, and the proof and official transcripts of the proceedings will be published on the website. I welcome members of the public and media watching the webcast. I now welcome representatives of APRA, and I thank all of you for attending today. We've got a very good representation of the senior executive of the organisation, and there are obviously a lot of important macroprudential issues. There always are a lot of important macroprudential issues, but particularly at this point in the monetary and fiscal cycle. For the benefit of Hansard, could I please ask that each of the representatives please now state your full name and the capacity in which you appear before the committee?
John Lonsdale, APRA Chair.
Margaret Cole, APRA Deputy Chair.
Therese McCarthy-Hockey, Member.
Suzanne Smith, Member.
Christine and General Counsel.
Thanks very much. I remind you that although the committee does not require you to give evidence under oath, the hearings are legal proceedings of the Parliament and warrant the same respect as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. I also remind members and witnesses to respect and adhere to the requirement to mute their microphone unless given the call. I now invite a member of APRA to make an opening statement if you wish.
Thanks very much, Chair and Committee. Good morning. It's very good to be here. So before you, we've got the APRA board and the McCann, so very senior people before you. I've got a short opening statement just to give. Thank you, first of all, for the opportunity to appear before the committee to talk about our annual report. On what we're seeing, Australia continues to experience a prolonged period of financial system resilience, supported by regulatory settings that have been strengthened and enhanced over an extended period. Financial services firms, however, face into significant risks, which warrant ongoing vigilance and preparation. The international banking issues associated with Silicon Valley Bank and Credit Suisse in 2023 had no contagion impact in Australia, yet the events offered lessons for how to strengthen APRA's tools, the resilience of banks and their response to stress events. APRA has since adjusted regulatory settings by improving and simplifying the framework for managing interest rate risk in the banking book, making targeted adjustments to liquidity settings, and is currently in consultation with industry on removing additional Tier 1 capital instruments. In July, APRA confirmed it would maintain the current macroeconomic settings, including the mortgage serviceability buffer at 3 percentage points and the counter-cyclical buffer at 1%. Macroprudential policy reduces financial stability risks at the system-wide level. APRA's published macroprudential framework details a range of risks and indicators that we monitor, including credit growth and leverage asset prices, lending conditions, and overall financial system resilience. In reaching the July decision, APRA considered the uncertain economic and interest rate outlook, geopolitical instability, as well as high levels of household debt and elevated inflation. We will, of course, continue to monitor vulnerabilities and risks in the system and review the settings of macroprudential policy. Superannuation is an important component of Australia's national savings. Against this backdrop, APRA continues to drive continuous improvement and trustee accountability in delivering quality member outcomes. The annual superannuation performance test, which assesses the long-term performance of superannuation products against tailored benchmarks, is a key measure, and year on year, the number of products failing the performance test is decreasing. As part of our ongoing efforts to improve transparency in superannuation, in October, APRA released a package of performance metrics and insights for 876 MySuper and Choice products, which collectively represent most types of investment offerings for accumulation members. We are currently examining trustee expenditure data at a fund level to ensure that RSE licensees' decisions are always in the members' best financial interests. You'll note APRA's recent enforcement actions in relation to 3 superannuation funds, reflecting our willingness to act should we perceive activities are not in the members' best interests. We are focused on ways in which superannuation trustees are supporting members entering or approaching retirement. Our work on the retirement income covenant indicates some advancements are being made, but still not tracking and measuring the success of trustee retirement income strategies. APRA continues to work alongside industry, regulators and government to address insurance affordability and availability pressures. Our work includes assessing data to consider some of the issues associated with protection gap in general insurance, as well as finalising an APRA-ASIC joint review into premium increases in life insurance. We continue to support the Hazards Insurance Partnership, or the HIP, to progress disaster risk reduction and natural hazard insurance. New capital standards for the private health insurance industry came into effect in July last year. They changed how capital adequacy is determined for insurers and has improved alignment with APRA's insurance capital framework, consistent, we believe, with international best practice. Countering cyber attacks has become a regular practice across our regulated cohort. Our work to help them lift their defences and response capabilities in line with CPS 234, the Prudential Standard on Information Security, is ongoing. APRA has recently extended these efforts to help regulated entities better manage operational risks and respond to business disruptions. The new CPS 230, which looks at operational risk management, will take effect in July next year. It requires regulated entities to set and test operational risk management controls and improve business continuity planning to better prepare and respond to severe disruptions. APRA released its corporate plan in August. It comprehensively, we believe, lists planned policy, supervision and data collection initiatives outlining regulatory expectations in the lead up to the regulatory grid. The plan considers current, emerging and long-term challenges like climate and nature-related financial risks and an ageing population. Another consideration is the digitisation of financial services, which alongside its benefits has been shown to accelerate transmission shocks in the financial system. In response, APRA has begun developing the first system-wide stress test to understand the financial system interconnections better and to quantify, assess and respond to identified risks. Strengthening governance is another area of focus in our ongoing work, including administrating the financial accountability regime, which comes into effect for insurers and superannuation trustees in March next year. APRA regularly reviews its own capabilities so it evolves as a modern and future-ready regulator. We've upgraded our technology and data systems following funding received in the 2024-25 federal budget. That's ongoing. We'll streamline the process of data submission for entities, improve data-driven supervision and APRA's own internal cyber controls. Finally, APRA recently restructured its supervisory groups, executive team and governance framework to improve decision-making and efficiency. We also established a supervisory excellence practice. These investments in APRA's people and processes cultivate an inclusive, agile and efficient organisation, and one we think will remain fit to foresee and manage the risks of the future. So with that, Chair, I'll hand to the committee for questions that you might have. Thank you.
Thanks very much. So I'll start with some questions, and a number of other committee members I know have questions also. So I just wanted to touch on the issue of general insurance and insurance affordability for home and contents. As you might have seen, we recently released a report on flood insurance, and won't take you through all 86 recommendations, but I just wanted to touch on this broader issue of affordability and availability for the very high-risk households, which I think is something that has been an issue for a long time, but I think it's fair to say has worsened. There were two aspects I wanted to touch on, and in particular, you've highlighted the fact that the government through HIP is working on developing a stronger evidence base. The Insurance Council gave us evidence that something like 230,000 properties they estimate are at a 1 in 20 year risk of flood or higher, and that's a number that's growing. In addition, there was the Actuaries Institute paper, which I think estimated something like 15% of households are at the point of their affordability measure, which I think is 4 weeks of gross income. But I just wanted to ask, firstly, based upon your work, is it fair to say that the number of households and small businesses in what you might call a very high risk category is material and increasing?
Thanks for the question, Chair. So I'm going to ask Ms Smith to come back to you with the answer, but just to reinforce, insurance affordability and accessibility is a major issue that we have been looking at, and we've got a number of initiatives that we have been working on, but I'll hand to Ms Smith to outline.
Thank you very much, Chair, and thank you for your report. I have had a chance to read all of your 86 recommendations, and I think it's a very comprehensive and important document because it does address a lot of the issues. I've also had a chance to look at the other pieces you refer to in terms of the Actuaries Institute report that does talk about that affordability. I think it is a significant concern. As to the numbers, I think there's a range of sources that are, highlighting actually the number of properties. And I think there is a general sense that with the direction of climate change, that's likely to increase. And I think what's really encouraging is that there is a really rich dialogue that recognises these issues right across the at the ICA conference last week. I know you were there as well and addressed that group of people. And the issues that we're seeing here in this country are consistent with what's happening across many other regions, such as, Canada, New Zealand and the others. So I think it is a material issue. I think there is potential for it to increase. And I think the work that needs to happen about how do we actually reduce that risk or try and, potentially take some of the stock out of the market, which I think is one of the solutions to address insurability, because some of those properties may not be insurable in the future. We're doing some work in terms of gathering data through our insurance vulnerability assessment, which continues to look at where those risks might emerge. We haven't actually received that data yet, but when we do, we'll be looking at that really closely. And I think importantly, think about how we share that data meaningfully with the industry to identify where those risks are. But I think how insurers sort of we need to find a mechanism to try and bring premiums down. I think the work that the HIP is trying to do around areas for mitigation and intervention are important, but there may be some areas of the country that, we can't actually reduce the risk, and the answer is that those properties shouldn't be in those places.
Yeah, and I think thanks for all that. And look, we look forward to continuing to work with APRA on your analysis. I totally agree that mitigation has to be a key element of this, but it is a very long-term strategy when you look at the whole country. And as you say, there are some areas where it may not be a short or even medium-term solution. The only other thing I wanted to touch on before getting onto another topic is that there's the issue of how many properties are at very high risk. But the other dimension of what's been happening in the insurance industry is that we've seen the availability of opt-out policies decrease over the last, say, 3 to 5 years. And indeed, during the course of our inquiry, one of the major insurers changed their stance on that. During the course of our inquiry, so they moved to offering only full cover policies, other than for a very small minority of legacy properties. That trend, when coupled with the number of properties at high risk, adds to real challenges for availability.
I think you draw that out really clearly in your report, and I think particularly when coupled with the significant improvement in the ability to identify where those risky properties sit. And so you've got sort of I think your recommendations around pooling are a really important one, because it is does underpin the access and availability of insurance. So I think the report signals where those issues are and what the consequence of them are. So I think we will continue to look at that and discuss with insurers what is appropriate. Ultimately, it's up to insurers to set their policies and set their premiums and the terms and conditions. We don't dictate to insurers what those appropriate ones are. But I think it's understanding what the impact of those is and actually thinking very clearly about whether that is the best outcome for the community, because the social licence of insurers to operate is really important, and actually those that and what that actually means to whether they can get covered. So I think the issues that you've raised are the right ones to discuss, and we'll do our part in raising those with insurers to get their views.
Thanks for that. So look, I just wanted to touch on a couple of issues around the broader macro environment. So in your opening statement, you talk about the fact that we're experiencing a prolonged period of financial system resilience. I think that, and I think this is in your opening statement, but if not, I think I obtained it from another document you put out very recently, but that overall credit growth is at around 5% at the minute, which is close to long run averages. So is that one aspect of the resilience of the system?
I just start with a general point and then specifically go to your question, Senator. I mean, financial system resilience in this country is what we have been working on every day. We come in every day to do it, and it's easy to forget the benefits of safety, but it's taken a long time to create a system that is safe and stable, and that is great for the country, the economy, provides jobs, it provides credit. And so I just want to come back to that point. So that's a really important point that sometimes we move over quickly, but it's an asset to the country. When we look at why we think that, yes, credit is an important metric that we look at. It's around 6% if you look at a 6-month average. So it's actually increasing a little bit over the last couple of quarters. The other key metrics we look at, if you're looking at the bank's capital levels, CET1, the core capital levels, an average probably around 12.5, 12.7 now. That's high when you think back to the GFC where we were talking about 8, kind of 9. And so we've got, into the 12s, plus we've got 4.5 LAC that sits on top of that. So all of that was sort of precursor from the financial system inquiry recommendations and Basel III. So there's been an uplift there. Liquidity, we think, is strong. We've got good liquidity levels. Credit standards, we would say, are very good. So if you look at high DTI lending, high LVR lending, they've all come down, which is good. Mm-hmm. Operational resilience is another one that has really come to the fore in the last few years, that I flag in the opening statement. And that's something that we've spent a lot of time uplifting through 234 and now 230 to make sure that if there are outages or attacks, that entities are able to handle that. And non-financial risks, we think, particularly since the Royal Commission, are in an uplift phase as well. And you can transmit that to insurance, and superannuation is another sector that we're pushing into, which will soon be the biggest part of the financial sector. In totality, we think we have a strong system when you look at those metrics, but I don't want to underplay the risks in front of us. There is considerable uncertainty in front of us. We've got a weakening domestic economy. We've got global uncertainty, particularly a lot more geopolitical risk. And many of our key trading partners have subdued growth prospects going forward. So there are risks.
No, thanks for all of that. And I mean, part of the reason I was interested in the credit growth numbers is that, in a sense, like a lot of economic variables, you're looking for a Goldilocks, in a sense, in that, or at least a number in a band that might be considered that. You don't want it too low, too high. If credit growth is too low, there might be a lack of access for credit for business formation or for people to enter the housing market. If it's too high, obviously that might speak to, as you say, too much credit, DTI, low LVR, or broader economic overheating. But when you see credit growth roughly near long-run averages, that provides a bit of comfort.
Yeah, that's right. And I mean, it is something, particularly when we think about the macroprudential settings, that we're continually reviewing. That is a key metric. So we're asking ourselves, where is credit growth positioned? Is there anything we're doing that might be unduly crimping credit growth? Is it too excessive? So they're the very questions that we ask ourselves continually.
Now, just speaking of some of the macroprudential settings, the serviceability buffers come in for a bit of discussion over the last, year or more. Just without going into all of the policy details, but can you just give us a very brief outline of, why is it there and why is it set at 3? And also, what level of flexibility is there around it? So it's set at 3, but presumably, banks have a little bit of wiggle room in certain cases?
Yes. So the serviceability buffer is one of the tools in our macroprudential toolkit. We last formally reviewed it and published our views in July. We'll be doing that again before the end of the year. But in July, what we announced was that we would be maintaining the current settings. So to be clear, 3% serviceability buffer, 1% on the countercyclical buffer. And the other set of tools that are not in play at the moment are any lending restrictions. So if we were worried about particular areas, we do have the capacity to intervene there. So they are the settings. What we said at the time was that we still see considerable uncertainty, and the role of the macroprudential toolkit is really to make sure that we've got a stable and resilient financial system. So they're set at the system level and they're set looking out too. So we need to make sure that the system is resilient, and that's important. It's important for the economy, for the community, and for growth and outcomes for ordinary Australians that we can do that. So that's what that toolkit is doing. Why did we land on 3, which I think is the answer? So if you go back a couple of years, I think you would say the balance of risks was in an rising interest rate environment. What we see now, though, is that balance of risks has probably changed. So we've got weakness forecast in the economy. We've got weakness in the labour market projected through unemployment, geopolitical risk, other global uncertainties. And all of those factors impact on a borrower's ability to meet their repayments. And so what we want to make sure is that where lending happens, where banks are lending depositors' funds, that those credit standards are good, And that's in the borrower's interests, it's in the bank's interests, and it's certainly in the financial system interest. And so we think 3% is the prudent number, given that. Having said that, a bit to your point, we're very aware this is a system-wide setting. We're not tailoring it for every borrower, and that is why we say to the banks that there's an exception to the buffer. So if they have a customer that might fail the serviceability test, but they believe that they're a good customer, maybe they've got a long track record of good repayments, there can be other reasons. We say to banks, look, you can extend the loan if it's in your risk appetite. That's up to you. We like them to report that to us, and we wrote to them last year setting out some of the requirements. What we're seeing is banks actually exercising that exception. So it used to run at about a couple of percent of loans being written. It's now around 5%. So it is being actively used, and if banks feel that they would like to extend lending subject to their risk appetite, they can do that.
Thanks for that. I mean, there is always a little bit of a tension in a macroprudential regulatory environment between allowing sufficient flexibility at the individual level, but having settings that make sense for the system. So, look, it's interesting to see that the number of loans where there's been a bit of that flexibility identified has gone up from 2 to 5%. But in terms of some of the outcomes that we're seeing across the system, is it fair to say that mortgage default rates are still at low and manageable levels, or what would your observation be there?
So they are still low. They're about 1.1% at the moment. So they're low but increasing. And so when you think about the period that we've been through and the increase in interest rates that we've had and cost of living pressures, that is still a low figure. However, having said that, they are still real people at the end of that. So 1.1% translates into, around $40 billion worth of loans and many thousands of customers. And, Ms. McCarthy-Hockey and myself have actually spent time on the debt management hotlines with major banks, with consumer groups, to actually listen to the calls, listen to financial stress. So although the figures, when you look at them, look low, there's actually a person or a family on the end of that number, and we're very cognizant of that as we are thinking about what the appropriate settings should be.
No, that is important. And I mean, the other side of it is, of course, that beyond the default rate, there are a lot of people who are being stretched, who aren't defaulting, but who are finding it difficult to service. And it's obviously important that banks provide people with, in a sense, flexibility and mechanisms that allow them to get through difficult periods. Are you seeing banks do that?
Yes, we are seeing banks do that. We're seeing banks.
Is that something you monitor?
I think, I might ask Therese if she's got any comments on it, but it is something that we're certainly interested in, and we talk to banks about their systems and how they engage with their customers, so that is important for good customer outcomes. I think it's fair to say that they have got better over recent years at identifying particular cohorts of people who might not just be experiencing financial stress, or who might be about to be, and contacting them and being proactive. And generally, we would find that the more proactive the bank is, the better the outcome is. But I might ask Therese if you've got any comments.
Yeah, thank you. This is a really great example of how we see agencies working together. So ASIC is a particular agency that looks at that consumer outcome. And we are the agency that's clearly trying to work with organisations, setting clear expectations about how you set up your organisation ahead of the challenges, if you will. And so, absolutely, as Ms. Lonsdale has laid out, we are seeing the intent of banks is much higher. There's a real wish to try and preserve the lessons of the COVID period to be able to put themselves in front of those challenges with their customers. However, as ASIC's work shows, and they did a report recently, not always that is the outcome. And there are small pockets of experiences that are poorer. So that's where ASIC is doing work more specifically, where perhaps an outcome wasn't as intended. So I think it is a balance, and that's where the two regulators work very closely together. We're about getting the banks in the right place before the challenges, but ASIC is really testing, did they get those outcomes? And that's not always the case. I think they appear today. So they would have some really good colour for you on exactly where there's some things that are going well and maybe some pockets that they are asking for a lot more and obviously prosecuting that in a more detailed way.
No, that's useful. Thanks. Well, look, I might provide both organisations with a question on notice just to get a bit more detail around your ongoing monitoring of that side of things. It obviously came up in our public hearings of the big four banks, but it's important to get the regulator perspective on this. Just finally, on the serviceability buffer, I mean, is it fair to say that one of the trade-offs here is that if you were to adjust the three downwards, or if you had the three potentially moving up and down over the cycle, there would be a risk of more households being at risk of default?
Well, that is a risk that we look at. It's not the only risk, but that is a risk that we look at.
Yep. Now, just finally, I noticed that there's some work that you're already doing, but looking to do further work on in relation to RSE licensee expenditure. So you're looking to examine, for example, getting greater data on and greater focus on discretionary expenditure on certain categories such as travel and conferences and other types of payments. I suppose just interested in any overarching observations on that, but in particular, one of the issues that has come up in this committee over a number of years, I'd say, is that where this comes up, one of the tricky aspects of it is where one fund might be a part of a bigger entity or owned by another entity, and some of those types of expenses, branding or entertainment or whatever, might be undertaken by the other entity. I'm just interested in your thoughts on, if you're going to start going down this path, what are the ways in which you might look through entities or, make sure that you're comparing things on an apples and apples basis?
Thanks, Chair. I'll ask Ms. Cole to respond.
Thank you, Chair. Yes, you're right. We published a letter. We sent a letter to industry last week about intensifying our supervision of fund level expenditure. That has garnered some attention in the press. We will be actually publishing data next week, next Wednesday, I think, that we've received. Just going back on that, APRA's had an extended period over several years of seeking to enhance transparency in super, as you will know, but it's worth just reminding ourselves of that. We've been careful or putting into the public domain as much as possible, subject to the rules and responsibilities we have on the data we collect. We have proceeded through our own version of performance data called the heat maps. We then have administered the government's performance test over a period of years starting in 2021. And over that period as well, we have been pursuing our own super data transformation project, as we call it. And what that has involved is a great deal of data collection over a whole host of issues. And data collection sounds simple, but I have to emphasise that it's not. It requires careful thought on the production of the standards for the required data to come in, and suitable technology systems to collect that data and technology and people to analyse that data. So it's been a huge programme that will be ongoing probably forever. I don't think we ever get to the end of that. So what's different as of now is that we have data collections now about expenditure and across actually a whole host of categories, and we've made a commitment to publish such, and that will be what will be appearing next week. Now, we're keen to explain as that process unfolds what will be seen in relation to data, because clearly there are some complexity in interpreting data. Very large funds will have inevitably large amounts of expenses in certain areas and will have perfectly legitimate expenses in areas such as marketing and administration expenses of their own activities. So we're very careful. We're trying to be careful to ensure that there isn't just a sort of, an explosion of noise around what all of this is. However, we have in prior work pushed into certain aspects of expenditure, which are areas which we think need careful attention. Discretionary expenditure such as travel, entertainment and conferences, for example, and some aspects of expenditure between entities and related parties. So, and in doing that, Chair and Committee, we have seen some things that are concerning, and you will have seen perhaps that we have taken forward some investigative work, and we are pushing forward on such matters. So that's the sort of backdrop, Chair, to your question. Now, we are hugely conscious that the models, perhaps of industry not-for-profit super and for-profit super are different, and so that the way in which expenditure is carried out and the way in which that is structured is different. So we're not, and we are agnostic in our view of what is right and appropriate in each case. So we are concerned also to understand in the retail model how expenditure works as well. And I am aware that I think it's fair to say, I can say there's a bit of noise about, is this just following certain items of expenditure in one sector? And I can say it is not that. However, when you do when you see the data and you start to look for the evidence, what we are going to do now is triage some of what we see and drill into those areas by following the evidence. I understand, Chair, your question, which is that perhaps this data won't always reveal where what level of a corporate structure the expenditure lies, but I can assure you that we are alert to that issue, and we are trying to make an agnostic, to provide an agnostic set of information and an agnostic set of inquiries.
And if I may, Chair, just to sort of jump in to give you a bit more colour about the extent of this data that will be captured under our expanded data collection. We'll be covering all sorts of expense group categories, including investment management, administration services, advice, member services, marketing, trustee, board, fund operations, corporate overheads and profits. So if you like, we think that will help bring to light all of the different ways in which these expenses incurred by funds, regardless of their particular model, emerge, and then we can get a better sense of where the money's going, who it's being paid to, importantly, and understanding what are the real benefits to members of those payments.
No, thanks for all that context. And look, just as a personal editorial comment at the end before I hand over to the Deputy Chair, can I just say I think a lot of the things you've identified in your statement are entirely appropriate for both examination and transparent reporting. And I would just add at a personal level, and this has come up over the last few years, as I mentioned, I just hope that in a very complex sector that ultimately the end point of what a lot of this analysis should be heading towards is the bottom line for members, which is the net returns on a risk-adjusted basis. And that, to me, is the ultimate thing which we're all trying to make sure that funds are maximising. But look, thanks for all that context around the latest initiative. And with that, I'll hand over to the Deputy Chair.
Thank you very much, Chair, and thank you all for appearing. There's two areas that I wanted to cover, and as per usual, the Chair has done a very good job of opening those. So I'm just going to pick at two two threads. If I just go back to the serviceability buffer conversation, it's just a very small point to follow, but we talked about giving the banks discretion to work within that 3% on a case-by-case basis, and you've seen that grow to about 5% of customers are captured under that. Now, that would suggest, I guess, that the banks have some greater level of confidence when they go on a case-by-case basis. But in the data they provide you, is there anything that you see in that suggests that there is evidence of greater serviceability issues, or that there are problems with lending into that cohort?
Into which particular cohort?
So where the banks have chosen to use their discretion to go beyond the 3% serviceability buffer.
So I'm not aware of any. We wrote to the banks last year to remind them of the serviceability buffer and talk about some of the requirements around serviceability buffer, as I said, which involved, if you're writing an exception, to report to us. So we do have reporting. When we look at that, I'm not aware of any particular issues other than the banks are using it as intended up to their risk appetite. It is an issue for them. I'll see whether Ms McCarthy-Hockey wants to add anything.
Yes, we see the banks using that serviceability buffer in quite, the exceptions to the serviceability buffer in quite a variety of ways. And it does go to exactly as Mr Lonsdale has said, which is the bank's own risk appetite. So some are using it quite heavily on, say, like-for-like refinance, for example. That's a category that we see some use it. Others, depending on where they're wanting to bank, they're seeing some more use in, say, first home buyer category and other. So we see a variety of uses. The emphasis, though, as we speak to them as they report those, is it's actually where they understand the customer well and they have a real confidence that they can service their loan through time, that they're not putting them into a loan that they can't support. But yeah, no, at the sort of end of the day, we think it's being done in a prudent way, and very much that those are customers who will be able to support those loans in the longer term.
No, thank you. I think it's a positive statement as it speaks to the broader system-wide approach to managing that risk. So that I think that's maybe something that wasn't explored as deeply when this topic is raised in the media. I think it's important to point out the bank's strength there. Can I just follow on?
Deputy Chair, I think that is a really important point. So it's set at a system-wide level, but we recognise that and so provide the exception. So you've got the top and you've got the granularity at the bottom that the banks can exercise. So this idea that there is, in fact, some flexibility, I think, is important.
Actually, on that, is it which banks? Is it just the big four who are using their discretion on that? Is it across the board? Is there the smaller banks use it as well? I guess is there a question there around which banks are better placed to use that? Because I guess in my immediate thought would be maybe the smaller banks don't have the data or the capacity to, but then again maybe they have closer relationships with the customers. I don't know.
So I don't have that data in front of me. What I'd say, though, is that the exception that we allow is available to all banks to write.
That might be something that I'll follow up with you later on to see if we can get some data on that. That's an interesting addition.
If I could add to that, even within cohorts, we see the banks using them in different ways. And again, it just comes back to that it is about their customer, the segment that they're targeting, where they want to grow their business, emphasise. So, it's a broad lending market, different types of borrowers across the board, different regions, different pockets. We are seeing banks really make choices as to where they want to operate. And I would say broadly, yes, actually, all different parts of the market are availing themselves of it as a general sense that they will, to the extent that they know their customer want to offer those exceptions.
No, thank you very much. And just to touch on the trustee expenditure data issue, and I want to acknowledge first, yes, the extensive amount of work that's gone on before the conversation got to this point, and also the delicate nature of proceeding when you have so much data that it can be very hard to understand what that means. So I acknowledge Ms. Cole's points on that and the care that one must take in how that data comes about. I guess in the context of a cost of living crisis, and when people are probably seeing returns on their super for the first time in a long time, it is a little alarming for people to think that their super fund may be spending their money in a way that's not to their best interests. Can you give some comments around, I guess, what is the scope and scale of this? Are we talking about, quite small, discrete sort of elements that you're looking at? Is it broader, and what are the realistic impacts that you are concerned about on members?
Look, I don't think I can, as I sit here now, do that ahead of the publication of the actual figures next week, but I think I can make some overall observations, which is that it is fair to say that the amounts on discretionary expenditure could be taken to be a rather small proportion of the size of assets that some of these very large funds are managing. So, and what that would translate to, and it would be possible to do those calculations when the figures come out, is cost per member attributable to such items could be seen as rather minimal. However, I think there is a wider point apart from the fact that the best financial interest duty in the legislation does not come with any materiality level in the legislation itself. I think it's important to bring home to trustees, if they haven't otherwise got the point, the significance of the fact that they're spending other people's money. And in using our, the tools we have to drill into this, make it more transparent, and perhaps, if appropriate, follow up and indeed take enforcement action, we're making some important points for trustees on that burden of responsibility that they have. Because in fact, although it might translate to a small amount for an individual member, there's a far bigger point at stake here. Absolutely. So I think that the way that plays out is that we've agreed, and in fact are required by government in our statement of expectations, the last one that we had, the most recent one that we had, to provide transparency as to expenditure. And we are doing that. We will then do the work on understanding what that means and seeking to explain what that means. And then we will do the work on whether there are particular circumstances that should be opened up further. So this isn't any kind of witch hunt. It's all part of a programme of transparency and shining a light, which I think is welcomed by all. And as you've acknowledged, Deputy Chair, there will be a point to continually explain about how to interpret such data. So we're very cognizant of the fact that there will likely be comments on this, and it is just not so simple as to be able to say there's a huge amount of money spent on conferences, for example. That must be something wrong. It really isn't that simple, and that is why this is such a complex exercise. But I think the underlying theme of transparency and accountability is the thing that we want to bring home to trustees.
No, quite right. And having watched the GFC in the UK and what was rightly called a witch hunt there, I think we want to avoid some of the extravagances of that. But forgive my curiosity on it, with all of the caveats put in the same. Can I ask, is the major concern around behavioural, sort of more individual actions or governance actions?
Oh, well, I think it comes back to governance. It comes back to having trustee boards who are completely clear what their responsibilities are, who ensure that there are the right policies, procedures and controls around expenditure, and who test the propositions that are being brought to them, presumably largely by the executive team on such expenditure, with great rigour. And it's not so easy, I think, for them to say, well, this sounded like a good idea on end of the scale. That's got to be tested. It's got to be looked at against how really is this expenditure in the best financial interest of members. The executive team have to clearly be doing that as well, but we expect boards to be oversighting that. And there's probably another point to make here, which is when the financial accountability regime comes into effect for Super in March next year, there are specific provisions in there. There are specific key responsibilities around marketing expenditure. So that will enable us to hone in on your point about, on the individual whose responsibility it is at any super fund for designing strategy around marketing, what it's to deliver, budget for it. So we will have somebody who's named with responsibility for that, who we can, in the first instance, deploy our supervisory attention to on the subject. So your answer is really it's both.
No, thank you. And I guess just at a very high level, the issues that you are looking at, it would be fair to say that directors would be aware of the decisions that you're scrutinising. That's the sort of the level of, if we're talking about governance issues, you're talking about things that are happening at the very top of a fund, or aware at the top of the fund would be aware of.
Yes, you mean the type of expenditure? Is that your question? Yes. I mean, I did mention that there's no materiality test in the legislation. Clearly, there's a materiality test in the reality of which issues we can take up and investigate and which issues we can drill into, which is why one of the tests we will bring into the further work we do will be the quantum of the expenditure, the type of the expenditure, and the nature of the expenditure.
And I guess just a sort of a wrapping up question, through this process, do you feel you have sufficient powers to scrutinise, to get data, to act?
Yes, we certainly have the ability to get data, and we certainly have the ability to investigate further. There will be, in due course, if there are actions that we want to follow up through enforcement, in the nature of things, we will be testing the limits of the legislation through any such actions, but I think that's for the future.
Excellent. No, thank you very much. And again, I do acknowledge the amount of work that goes into an exercise like this. So thank you all. Thank you, Chair.
Thanks, Deputy Chair. Mr. Laxale.
Thank you, Chair, and thank you to APRA for coming along to this hearing. I've got a few questions on the serviceability buffer as well, if that's okay. And apologies if you may have already answered some of them. I wasn't here for the Chair's questions, and if you have answered them, just please let me know and I'll have a look through the transcript. Just in terms of I think you've answered questions about why you've kept it at 3%, and I'm happy to go through and look through the transcript there. But just in terms of how often you review the buffer, and if you could give us an understanding of how you review it, like what data do you look at, what considerations do you take when you meet to look at the serviceability buffer?
Thank you for your question. I think the short answer is it is continually under review, as are Macroprudential settings as well. But on Macroprudential settings, we're always looking at the data, always looking at new release. If there was something that bothered us, that would create a lot of scrutiny. So that's the short answer. There are 2 times during the year where we're publishing a formal note, if you like, which outlines how we're seeing the Macroprudential settings going forward against the framework that we've published. So if you go back to 2021, we've published a framework on how we think about the Macroprudential settings. So what are the tools, if you like? what are the key things that we would look at? So it talks about asset prices, it talks about leverage in the system, it talks about credit growth and overall financial resilience. And in relation to changes in those metrics, how do they relate to the tools that we have, whether they're the serviceability buffer or the countercyclical buffer or particular lending restrictions, which we have used in the past, if you go back a decade or so. So we have a framework. Twice a year, we have if you like, a more formal look against that framework. That would involve formulating our own views, including very senior people here, scrutinising that, particularly the people sitting at this table. We would also consult our CFR colleagues. So in particular, you have the Reserve Bank, who will have, data that's very relevant. There will also be, a link between monetary policy and macroprudential. Sometimes, during the cycle they'll work together. Sometimes they may not work together. And so that was an issue that has been highlighted by the Reserve Bank review that was done. So there's an important link there, as well as Treasury and ASIC. So we're all talking at the CFR about the settings. But I've given you a short answer, but also a longer answer. I hope that answers it.
And so you mentioned you always look at it, but you've got that twice a year more formal look. If you were to change the serviceability buffer, would it sort of be restricted to that twice a year formal look, or do you have the flexibility to change the buffer or have that more in-depth look at any time? Is that something that you have the power to do now?
So at any time.
At any time, okay.
If we saw something, and to be clear, which I talked a bit about before, these tools go to overall financial system stability.
Mm.
That is central to the well-being of the financial system and the economy and all Australians. So if we saw something out of that cycle that I explained that we were concerned about, then we could certainly act. And what would be an example of that? The pandemic is a particular example of that, where, that came, for all intents and purposes, very quickly to the fore on the financial system at the beginning of the year. APRA acted very quickly in concert with other regulators to think about, first of all, the regulatory settings that apply, the posture of how we'd be applying regulation, but also to apply broad-scale loan deferrals. And, very quickly they were applied, and they applied to around 10% of the mortgages in the country. And that was a very large intervention done at speed. We also looked at dividends. There are a whole range of things that we looked at speed that was very much outside that cycle. So if we saw something, we would act.
And so, given the last change was back in 2021, and obviously circumstances today are very, very different to what they were when the current buffer was set. Give us an understanding of how the buffer has stayed the same despite the wild differences in seemingly wild differences in economic circumstances and credit circumstances. Could you sort of explain that a little bit?
Yeah. So, we have increased the buffer. The buffer was 2.5. It's increased to 3. So it's not quite right from 21. So there has been change.
Mm-hmm.
The way that I'd describe it is, what we're trying to do is maintain financial stability. That means thinking about the risks going forward. And the risks, as you outline in 21 or even 22, the balance of risks, are a different set of risks that apply now. And so if you think about say 22, for example, if you think about 21, we're dealing with a pandemic. You think about 22, we're facing into a rising interest rate environment. When we look at what we're seeing now, the balance of risk has changed. So we're seeing, an economy that is forecast to weaken. We are seeing unemployment projected to increase. We're seeing growth in many major economies at subdued levels. We're seeing, particularly over the last 2 years, very increased in geopolitical risk. And I can go on, as well as cost of living pressures. All of those risks manifest in a borrower's ability in some way to either earn income or pay the expenses that they have to. And so we take all of that into account in forming a view, not just on the 3%, but the other tools that we have.
Thank you. And so perhaps if I illuminate a little bit like exactly what the data says. So there's all those uncertainties there and the circumstance is different. And actually, before I start to talk about the data, we're looking at actually thinking about what we are solving for. So there's a system, but it's a through time. So it's certainly not about, what's the next move in interest rates, for example. It's not short term, it's long term, it's through the life of the loan. Notwithstanding durations are shorter than sort of maybe technical term of loans, but still we've got multi-year phases that the borrower groups need to move through. When we look at the data, we're asking ourselves, what is the case for change as well? So we say, well, today lending is holding up. And something we were talking about a little bit earlier today is there's one thing to have lending sort of subdued. Are we crimping lending? We certainly don't want that happening, but we don't want exuberant levels either. That's where you see us come in to slow down what we see our pent-up potential of rising risks in the system. So what right now we have is this long-term average level of lending. We see that lending in the across the home borrower sectors. We see that actually in owner occupier. We see that in the first home buyer segment. That's a sort of sub portion of that. Investor lending also similarly, not exuberant, not crimped or falling low, something moderate and in a long-term average. So that gives us confidence that actually the settings would be about right. Then we look for the other side and say, well, what are the things that we see in the data that actually might alarm us or give us watch factors? And one is the non-performing loan numbers. So if you look at 2016, that number was sort of 0.5%. If you look, ignoring the sort of COVID noise in the numbers, but that's above 1% now. So it's more than double that. And in an environment where employment is very high. So if employment falls away, we would expect the hardship experience of the borrower group to really be much higher than it is. And then that would be a cause for concern. So whilst we see this good provision of credit in the system, this ongoing ability for banks to lend, the other side of it is actually what's this watch factor. And we do see a watch factor that we're quite alive to and thinking about. And if I leave you one more sort of thing we think about is if credit was being constrained or if these settings were wrong or not right for the times, you might see things like the non-bank sector playing a much bigger part or a much bigger move. That continues to be an important part of, I think, credit provision, but in the single digits still. So again, that balance of banks being able to perform their role and the ongoing provision of credit, a watch point around actually the performance of the loans, and then how that balance of the system looks, sort of broader than even just the direct banking sector. So that's sort of how we think about it. There's a sort of what we're setting for and then this uncertainty, but also what's the case for change. And right now it does look to be the right level that has served us well.
When you mentioned that the credit amount was was healthy. Sorry, I might paraphrase that incorrectly, or as maintained at this at the current serviceability buffer. Are you talking about in terms of dollar value or in terms of the amount of loans written?
Percentage. Yeah, percentage of credit provided to the system.
Okay.
The percentage credit.
Have you do you model sort of the impact of your serviceability buffer at lower rates before you make a decision? So, like, would you model it at 2.5% in terms of its impact on increasing demand and looking at risks? Like, before you make the decision, do you have the data in front of you to say, here's what it would be at 2.5%, here's what it would be at 2%? Is that something you consider?
So there's no model in the way that you described, but there is certainly a framework that we apply that I talked about before, and that's a published framework. And that framework would entail quite a lot of statistics actually on what credit growth is showing, what asset prices are showing, what the leverage in the system is, and a whole range of financial system metrics, and where the tensions are. As Ms. McCarthy-Hockey said, non-performing loans, for example, is on the other side of that equation. So we certainly talk about what the data is showing, what the data could be. So we're not in the space of forecasting, but we are in the space of thinking about what are plausible risks that could happen, and they're very robust discussions. And we do look at questions like, where are we? Where could we be? What would happen if we cut, or what would happen if we increased?
But you don't model or forecast that sort of, as you just said there, you look through the prism of of the published guidelines, but it's not really sort of a forecasting exercise that you go through.
We don't forecast. No, we don't forecast. It's a broader judgment than a forecast on a metric. What we're talking about here is a set of tools that provide financial stability over the cycle ahead.
Can I, if I allow, to add just the context that we're doing our work in? So for Australia, we have one of the highest household debt to income ratios in the world, and comparable, at least to most. In comparison to most comparable economies, and that has risen. So if you look to that long-term sort of provision of more capacity for debt, we have seen that rise from 1.5% to 2% over a sort of 20-year period. So it goes to that these settings. It does go to that long-term view that we have, but also recognising that is a very material risk in our system, and it is about making sure that we are able to, regardless of these sort of scenarios and stress events. The truth of it is, in stress events, you can plan and prepare in the very best way you can, but you can't. It's always. The actual reality of a scenario can be quite a little bit different than you expect, or quite different. It is about that resilience to the sort of various sort of shocks that we can see or that we envisage, which goes to all those uncertainties that Mr. Lonsdale has laid out.
Okay. Just in my final few questions through you, Chair, I'd like to sort of ask you a few questions, I guess, on behalf of renters out there. I'm sure there are plenty of renters who would like to get into home ownership, be it their first home or just transitioning back into home ownership. And I'll give you an example. So I'm in the electorate of Bennelong. Macquarie Park is where there's lots of apartments, and a 2-bedroom apartment in Macquarie Park's about $800 a week. I went on real estate just in preparation for this, and you could buy a 2-bedroom unit for $650,000. If you get your standard 80% loan, that's a $520,000 loan. Repayments are about $750 a week on that loan, so less than the rent. But with a 3% serviceability buffer, renters would have to prove that they could service, or they would have to service $975 to $1,000 a week. I think that's a problem, right? Like, do you think that it's not the same playing field, particularly for renters trying to get out, who want to get out of that cycle? Like, how does a 3% serviceability buffer, in these circumstances, not penalise renters or make it harder for renters to get out of renting and into home ownership?
So it's a very good question, and we know it's a matter of public interest, particularly housing affordability. So just to be clear on what our role is, first of all, so we're the Prudential regulator. We're charged with keeping the system safe, the financial system safe. And that means for depositors, the $4 trillion worth of depositors, where those funds are being lent, are lent with creditworthy standing. And that actually includes renters who are saving to purchase a home, who are depositors. So keeping the system safe, and a safe system and a stable system actually provides the ability for investment to happen too, investment in housing, and that's good for the economy. So we're operating at the system level. We don't have a particular mandate for affordability for particular cohorts of borrowers. Having said that, as we talked about before, although we've got a set of system tools, we recognise that these levels, particularly serviceability buffer, may not suit all borrowers, and there may be good borrowers who actually can't pass that test. So banks have got the ability and the flexibility, subject to their risk appetite, to write the loan. And so that is something that they have been doing of late, and it's something that has been increasing of late from about 2% to 5%. So there's the system-wide tool and there's flexibility at the bottom end.
And why do you think, you said some are doing it of late. There's been some commentary over the past few days where if that flexibility exists now, and I know Mr. Molina asked some questions about flexibility, but if that flexibility, you say, exists, why have we had the Banking Analysts Association and two of its members come out and say one thing, that the buffer should be lowered? Like, if they have the power to be flexible, shouldn't they go out there and be flexible?
Oh, well, that's an issue for the banks themselves. What I'm saying is that the banks currently have that flexibility, and the data that's being reported to us would show that that exception is being used. But at the end of the day, it is up to the bank. It's up to the bank's risk appetite and whether they're willing to write the loan.
Then why are they calling for the buffer to be lowered for first homeowners then if you're saying they already have the flexibility?
Well, that's a contested view on what the buffer is. So we're saying from the Prudential regulator's point of view, here's how we think about it.
And what's the, again, sorry if you're going out, what's the process for this flexibility? Because the impression I got in reading about this is that, particularly from comments from the ABA, NAB and ANZ, is that they kind of didn't have that flexibility and they're restricted by your buffer. From the evidence you're giving here, you're saying that's not the case. So what are the circumstances surrounding the flexibility? Do they have to report to you? Do they have to apply to you? Or is it just something that they've got? Like, what are the mechanisms for applying this flexibility?
Yes, so we wrote to all regulated entities, all banks last year, setting out what the process is, but in broad terms, reminding them that they have the ability, where they come across a good borrower that might not pass the serviceability requirements, to write the loan, as long as it fits within their risk appetite, as long as it's done prudently, and there are some reporting requirements to us. But in broad terms, that's what it is. But at the end of the day, it is up to the bank on whether they're going to write the loan or not. What we're saying is we recognise that we're setting levels of serviceability buffers at a system-wide level, but we're also providing the discretion for banks to write loans if they feel that they want to.
I think if I could just add, what we do is we look at the risk. So we're a risk-based, neutral setup. We're not incentivising any one category. And from that regard, first home buyer and owner-occupier, in the main, over time, the loan performance is very similar. Therefore, it's a similar settings that we have for it, similar settings in terms of the way the risk-weighted assets work. They will be on a consistent basis, adjusted for the features of the actual borrowing. And then also for serviceability, we say for first home buyers, we don't see that they should be any less resilient in a broader sense, that we shouldn't give them the same protections. And that's why it's similar. That said, you had some example that the features of a particular loan, that is when, say a borrower's performance against rent performance and so on, they are absolutely the kind of things that banks can and should be looking at. But it is for them to put those controls in place. It's harder. It is harder to do. Banks need to have good control.
If a borrower had
Final question, please.
if the borrower had a long history of paying rent at a certain level, and repayments on a loan would be less than that level, you're saying that that's something the banks should take into consideration if they've got a good rental history. Yeah.
What we would say is they could take it in.
They could, sure. They could,
So they could. So first of all, they have to want to do that business. Sometimes they don't want to do that business. It's not the segment they're banking. They've got to focus. They've got a certain amount of capital. Okay. They're putting it to work perhaps in small business, or they've got a particular regional focus. That's really up to them. But they could if they wished. But if they do, they need the right controls. So it's not about just, I just wish to try and do some business in a particular sector. If you are going to bank that segment, you understand that segment, you know that borrower, you can track that borrower, and moreover, you can support that borrower through time and the way they need. So it is about having the right investment up front in your technology, in your banking capability, and so on. It is an important business they're doing over that their borrowers that they put into loans can support those loans over the longer term.
Thank you.
Thanks, Mr. Littell. Mr. Van Manen.
Thank you, Chair. And can I thank you, Mr. Lonsdale, and your team for your opening remarks and your answers to the questions so far. I'll probably revisit a little bit of territory, but I want to go to a couple of other topics, time permitting. Firstly, probably more a comment than a question, but I'd be interested in your view on this. The serviceability buffer, as you commented earlier, Mr. Lonsdale, your responsibility as APRA is a system-wide integrity responsibility to ensure that capital adequacy is in place. But at the end of the day, the reason for all of these regulations, all these capital adequacy requirements is ultimately to protect depositors' funds, correct?
Correct.
And therefore, the capital adequacy requirements for necessarily the provision of loans, etc., is a secondary concern to protecting depositors' funds. Is that a fair statement?
Well, I wouldn't say it's secondary, but our mandate, just to be clear, is for financial system stability and to protect depositors' funds, make sure insurance holders can claim a valid claim, and superannuation trustees' money is spent, superannuation members' money is spent in the best interest. That's our mandate.
Yeah.
But in lending those funds for deposits, we need to make sure there's adequate credit standards. So they go hand in hand, but our ultimate protection is to the depositor.
Yeah, absolutely.
Could I just to unpack, if you will, what the capital standard is? Perhaps that could be helpful to you.
Yeah.
If you unpack our capital standards and our capital rules, they are a measurement tool. they seek to, over the longer term, like looking at data over the longer term, look at what is the risk in the system. So when depositors' funds are put to work, what is the risk profile of any one lending category? And so that it measures that. It's a bit like, it's very simple perhaps, but a ruler measures length. Our capital standards measure risk. So if you do a particular lending in a particular area, or if you have it broadly set, every bank has a number that comes out the end of that. And then against that is capital. Now, the good thing about that is that means that commercial operators understand the way we measure that risk and the risk that we see around that, and they can then make their commercial decisions. Equally, government can say, oh, that's interesting, APRA, this is what the measure of risk is. This is how we'd like to change that profile of that risk. So, for example, first home loan, first home buyer schemes available at the moment, they actually change the risk of a borrower. And so then our standard, our capital framework recognises that lower risk and adjusts the capital accordingly. And you can see that's actually made a difference for some home borrowers in that category. And then the final thing to not forget is that we're a capital importer. Broadly, Australia, we rely on capital flows to Australia and liquidity to support our system. And that sort of strong understanding, a framework that actually measures risk, so that when you see the capital ratios and the risk-weighted asset allocations across the system, that international investors can understand that. And that has meant things like our ratings for Australia's ratings and for our banks, they are actually generally very high, and our recognition, in fact, there's more recently S&P had a BICRA rating, which is a bank index rating, and it's given one of the highest ratings in the globe for our system based on the Prudential framework. And that goes very much to that capital, the measure of risk, the understanding, the clarity, the transparency, and the sort of strong calibration around that. So I just don't want to underestimate, just want to sort of lay out to you how it works and sort of the way and what value it gives, and it's for domestic as well as international.
No, thank you for that. And I appreciate that. And having had a long career in banking and financial services prior to politics, so I have a reasonable understanding of that space. But the ultimate aim of all of this is to protect depositors and investors' funds and ensure there's the coverage in the system to do that. Can I ask a follow-on question from that in relation to the track Mr. Laxale was going down about the bank's willingness or not to lend outside of or use that flexibility that you say they have outside of the 3% buffer as a hard marker? If they do provide loan facilities using that flexibility that they have, that or that discretion they have, do they incur any additional capital requirements than they would if they stuck within the 3% serviceability buffer?
Well, the capital requirements are set out in the standards that we've got. I think we outlined that yesterday to another committee. But particularly if you take the standardised risk weightings, they vary according to the LVR and according to the loan to valuation ratio and according to whether there's LMI on the loan. So, there is no change to that. But of course, if you're providing a loan to, say, a higher LVR lender, maybe that wasn't passing the serviceability test, well, yes, there is a difference in the risk weight, but it is not. It's not something that varies.
No, but if we use Mr. Laxale's example of a first home buyer who would be in a position where their repayments on an 80% loan, so there's no LMI, it's a reasonably standard loan proposition in this day and age, 80% valuation ratio. Their serviceability position is $950 or $1,000 a week as opposed to $750 a week in actual repayments. What, if any, in that situation, what, if any, additional requirements, capital requirements would be on the bank if they decided to lend that money, given that they're using their discretion outside of the 3% serviceability requirement.
Yeah, so the short answer is there is no change to the capital ratio for a given loan based on the banks availing themselves an exception on serviceability.
Okay, thank you. Appreciate that. I'd like to go to a couple of other topics which you touched on in your opening remarks. I'd be interested to sort of get a broader picture of where you're at in the work you were doing with the review into premium increases by life insurance companies. Can you give the committee any more detail on where that work's at and what your findings out of that are?
Yes.
So in terms of the work on life insurance, APRA is working closely with ASIC on that, and we asked the life insurers to have a look at the way that they are putting through increases in premiums, whether there was an understanding of the mechanisms and the terminology that's used in the life market, so around stepped premiums and level increases. So we've written to life insurers, and life insurers have gone back and had a look at across their portfolios as to whether those increases were appropriate. My understanding is that we will be writing again soon on that. We did the joint letter back in December 2023, and we're jointly meeting with entities across sort of the rest of the year. So we continue to look at the way those premiums are being implemented. We engage very openly with life insurers. We're working with the Life Insurance Industry Group, which is the Cali board, to help set expectations across the industry. And I think the work on that is ongoing.
So in relation to that, I believe you've also been doing some work over the last 12 or 18 months in ensuring life insurers and the insurance industry more general has adequate capital, an adequate capital position for claims payments, etc. What, if any, issues have you found in that space, and where insurers have had to put more capital in or the capital adequacy requirements have increased? What work have you done to identify whether that's reflected in premium increases that we all know we've seen across the industry, both in life insurance but also in general insurance?
I think we have our capital settings in place, and they're the requirements that insurers, whether they be general insurers or life insurers, need to have in place capital that reflects the risk that they're taking on. And so I think that's an ongoing part of our regular supervision, is looking at the capital position of each life insurer, and where we see any issues in relation to that we would deal with that on a case-by-case basis with each insurer.
So have there been any cases where they've had to increase capital coverage that are on the public record or that you can share with the committee?
Not that I'm in a position to share, but anything, I mean, I'd have to take that one on notice as to whether there's anything on the public record.
Okay.
No.
So in cases where you've identified a need to increase capital coverage for whatever reason, are you then monitoring to see, subsequent to that, what, if any, increases are occurring in premiums in that space or for that company, to ensure that the company, in having to increase their capital cover, are not unduly increasing premiums to fund that?
So we don't have a role in setting premiums. So our role is looking at the safety and stability of the system and having the appropriate capital in place. So wouldn't say that we are monitoring on a product by product or, the actual flow through of premiums. Saying that, I think the reality is that there are a lot of challenges in the life insurance market. We know that growth in that market is challenging. We know that lapses in that market are also challenging the profitability of many insurers. So I think it is up to the insurer to look at the way that they price their products in accordance with the business that they're running. And our role is to make sure that when we look at the financial metrics, that each insurer is, well positioned to meet the obligations that they have.
But we've all seen a massive increase in insurance, not just across premiums for life insurance, but we've seen it across general insurance. We're seeing an increasing discussion about the affordability of private health insurance. Now, there's a range of factors that go into that, but surely if you're identifying issues from a capital perspective in any of those insurance sectors, and you are doing work around premium increases by life insurance companies, surely a lack of capital. They've only got a couple of ways of increasing their capital base. They can increase premiums to ensure they've got more funds. They can get more shareholder capital. They can get investor capital. How, in your work, how are you keeping track or identifying, or what is the responsibility of those companies to report to you of how they've rebuilt their capital requirements?
So the life insurance industry has a lot of challenge, but it is has a lot of challenges, but it is well capitalised. And so our capital settings take into account a whole range of factors. What is the base level of capital that they need to hold? What are the different exposures that they have and the risks that they take on, whether there are any particular areas that would warrant them holding additional capital. So our role is to make sure that we have strong and stable and well capitalised life insurers. Where we see issues emerging, we track that through the information that we collect, through the financial metrics that are provided to us, and that to the extent that we saw issues, we would take action.
So in relation to then with life insurance particularly, and you touched on it earlier, lapse rates, what are you seeing in the lapse rate data? Are you seeing a growth in lapse rates given premium? When I talk to advisors or people in the life insurance industry, as premiums are going up, and people are trying to make ends meet, that's potentially one of the first things that goes.
Yeah. So in terms of the retail industry, we have seen an increase in lapse rates. We know that retail sales in that market have, shrunk by 50% over the last number of years, and there has been an increase in lapses. That could be for a range of reasons. We know that it's hard to get access to advice for consumers these days. There is a cost of living challenge, and so as premiums go up, people may adjust. That may be full lapses or partial lapses. So we are seeing an increase in lapses across the life insurance industry, and I think that's one that life insurers are watching. And just back onto your question earlier, in terms of capital increases, we actually haven't had any capital increases that we can discuss publicly.
Okay, thank you for that. Chair, the last question, I just want to touch on if you can give the committee an update on the work you're doing with the Hazards Insurance Partnership, because you refer in your opening remarks to that you continue to support that. So can you give the committee an update on where you're at with that and what's happening in that space, please?
So that one will come back to me as well. So we are an observer on the Hazards Insurance Partnership. We're on the participate in the working group there, and we also attend all of those meetings. So our role there is to help provide data and information. As part of that, we are, currently working to see look at those areas of exposure and where we can work to provide any of the data that we can gather into that to help sort of expose where the underlying levels of risk may be and whether that informs some of the work, the decisions that the Hazards Insurance Partnership will make on where mitigation and investment may be best deployed.
Can you give us any idea of what sort of data and information you're providing into that is helping inform those decisions?
So we're currently undertaking a climate vulnerability assessment where we're gathering information from the insurance industry on likely potential impacts to premium under a range of different scenarios. We haven't received that information yet, but once we get that information through, that will likely be helpful to the Hazards Insurance Partnership.
Okay. Thank you, Chair.
Thanks, Mr. Van Manen. Ms. Payne.
Thank you very much, Chair. And thank you for the opportunity to ask some questions today. I just wanted to ask some about HECS help loans and the treatment of, or APRA's advice on how those are treated by banks in considering loans. So obviously the help program is an income contingent debt, which is unlike credit card debt or personal loans. And I'm interested, what does APRA see as the rationale for treating these debts in the same way as traditional debts in debt to income ratio calculations when assessing mortgage applications?
I think thank you for your question. I think the short answer is we don't provide any specific guidance on the HECS debt other than the general serviceability requirements that we've got, in the standard that we require banks to work through. We do make it clear though, and they're aware that it is a contingent loan, so they need to think through, well, how does that affect expenditure for a potential borrower? But at the end of the day, up to the bank to make that decision.
Okay. Because I've had this issue raised from a few people in the community, particularly young people, but also people, for example, a constituent who's separated from their spouse and now struggling to buy their own property. So it is having an impact on people. Do you think there could be a case to reclassify help debts in a way that reflects that unique nature of the debt?
Yeah, I'm happy to take that question. So you're very right in identifying the unique contingent nature of the debt when the borrower is, the person is below a certain tax threshold. However, another feature of the debt, which is more onerous, we would say, is that actually it comes directly out of taxable income. So unlike, it does behave differently. There's no flexibility on paying your HECS at the moment in the way it's structured. So banks are required to look at when we don't, and just to be clear, we don't have any obligations on the way to think about that particular debt other than to really understand it, what's right for that customer. If a customer is below the threshold, then that's one thing. Or some banks we know think deeply about, well, is this person with many tens of thousands of dollars and started the journey of their HECS debt? Is this person close to the end of their repayment? So it's actually tailing off. And I think that was evidence given yesterday in another hearing. So we can see the flexibility, but really understanding that it is coming out of the payment capacity first is an important feature, as well as the contingency piece. So it works together and it is about that detail.
Mm-hmm. Thank you.
Ultimately, it's about making sure banks are making loans to people who can make sure they can honour those payments through the life of the loan. So, but that individual circumstance is always something that banks need to be looking at.
Thank you. And as you're likely aware, the Universities Accord has recommended reconsidering the way help debts are factored into mortgage assessments. Do you have a position on those recommendations?
Well, they are a matter for government. For right now, we say to banks, understand the features of the HECS debt as the obligation arises today, and make your lending decisions accordingly. And as they stand today, we see banks considering that, and that we think is appropriate.
Okay, thank you. Have you conducted any assessments or engaged in discussions with financial institutions about the potential impact of revising DTI guidelines to differentiate help debts from other debts?
So you're referring here to a reporting standard. That's very different from the assessment of a loan. So I think that's worthwhile distinguishing. And we have a range of things that banks submit to us in their data. And that's one part of some data that we collect, but it doesn't override the lending decision criteria that we set out. So it doesn't relate to the lending decision, it relates to the reporting standards.
Okay, so it would be factored into the lending decision as well. No, I'm certainly hearing from people that it does when they're going for loans.
So I think, the point here is that a borrower presents with their individual borrowing profile. If that person has HECS and they're paying their HECS and it's coming out of their income before the loan is assessed, then it's appropriate to consider that in that person's ability to pay. Now, there's a range of things that banks look at in making their assessments, all manner of things: how much deposit is available, what's the property profile. There might be some individual circumstances they consider on an exceptional basis. They all are considered, but the overall debt to income ratio from our perspective is simply a reporting perspective. If a bank is using that in their own way, in their own machinery for decision making, that is a matter for them. We're not requiring that per se, and it's quite distinct from our reporting requirement. The lending standards are consistent for everyone in terms of it ultimately comes to the own bank's credit policies and processes.
Okay, thank you very much. Thanks, Chair.
Thanks very much. I'll hand over now to Ms. Spender.
Thank you very much for your time today. I wanted to start the questioning in relation to superannuation. Particularly, I spent a lot of time with people in the sort of venture capital and the in the technology sector, who are sort of very interested and doing a lot of innovation. But there's a lot of concern that the amount of contribution of the super funds into this sector is actually declining, sort of as a proportion of the super funds assets, and this has an impact on the broader super sector. So I guess what I wanted to start with was. And some of the feedback around this is around it's the Your Future, Your Super. It's the idea of fee budgeting, which certainly seems to be an issue with some super funds. And what this is doing is compromising the opportunity to have greater returns. The VC sector, for instance, has had, I think, over the last 10 years, returns of around 18%, while the sort of ASX or, the sort of listed companies, I think, is around 8 to 10%. So the concern that this is impeding, I think, both returns for retirees or potential retirees, but also it's also compromising, the ability to fund, innovative companies that are really important for sort of productivity. So I guess my question really is, while acknowledging Your Future, Your Super has been, I think, really important in terms of driving consolidation and sort of weeding out some of the low-performing funds. Is APRA interested in have perspectives on whether there are whether a focus should be more on net of fees, perhaps, rather than sort of returns net of fees, rather than the current return, sort of the current structures coming out of Your Future, Your Super?
Well, lot of points there. Your future super obviously is government legislation, and the performance test is run by APRA on regulations that the government promulgates. And there have been, I think, at least 2 reviews of that since the performance test came into effect back in 2021. So I think if there were to be any change in the settings, that would be a matter of government, and it would have to flow through in the regulations. As to investments, obviously each of the super funds sets its own investment strategy. It's required to do that carefully and appropriately pursuant to our standards, but provided that those standards are followed, we would not have anything to say about the sectors in which they were to invest, or the countries in which they were to invest, or any of those issues, because that will be a matter for the super fund, informed by its investment professionals and its investment committee and its advisors.
I guess I take your point that it's up to it's government legislation. I'm just interested in whether APRA has any perspective on whether there is an opportunity, or whether there are any concerns actually to with any of those sorts of changes in terms of stability, or from a prudential point of view, if there were changes that focus more on net return. Sorry.
Well, I think the overall objective is, as Steve pointed out several times in this hearing so far, is a safe and sound super system that delivers the best possible outcome for members. I'll paraphrase that as the exact words in our mandate. And within that, we obviously have a super sector that is very large, as the chair pointed out in his opening statement, getting larger and larger, a very significant part of the wealth of this nation, managing sums of money that are very significant for individual members. Some super funds are absolutely enormous, as you know, and some they cross a span down to much smaller ones, some of whom have particular sectoral connections. I believe they're all trying to manage those assets in the best interest of their members. How they go about it, though, is subject to a range of considerations. The very large funds, probably have a real issue on where they place the money consistent with their obligations, because their inflows are so enormous, and that is why you see moving beyond Australia into other investments in other countries. So there's just such a huge variety of considerations to take into account when you think they're trying to balance the portfolio between more risky investments that deliver high returns and less risky investments that underpin the overall portfolio. So I think it's very hard to pick out a particular area and say that would have this impact or that impact on the stability of the system. Clearly, if government were to mandate something in relation to a particular area, which I haven't seen so far, but I would expect that to be, we would be asked whether that had any implications for stability. But I do think it would be difficult to take those responsibilities away from the trustees of the funds, who are best placed to oversee the investment strategy and its investment spread.
I'm not saying that at all. I think to say that the government should take over, I'm just saying any changes to the reporting, would you have any concerns? But it sounds like you're saying that this is government policy, so you'll wait to see.
We run the test based on government policy,
sure.
So since we're neutral as to what underlies that.
Okay. Then I want to talk. I mean, this comes from a concern I have about lending to business, when I speak to young dynamic firms, I speak to small businesses in my community. Access to capital is a significant issue, and what I'm seeing also from when I look at sort of the RBA statistics in terms of business lending, what you're seeing, what we've seen actually over a period of time, and I'm sort of looking up at a chart in out of the RBA pack, is that we have very little unsecured lending to small businesses. It's not growing at all. So what we're seeing is some growth in lending to medium businesses and some growth to lending in big businesses, but really flatlining lending to small businesses. And this is, I have a concern across this in the economy. I'm really interested in APRA's perspective on this. Are there any issues? Do you have any perspective on why this is? Are there ways of addressing this or not, or is this even a concern to APRA, or is this something that is not on your radar?
Well, we do. So thanks for the question. I mean, credit growth is an important aggregate, as we've discussed before, that we look at. So overall credit growth, but also business credit growth, which at the moment is running about 7.9%. But as you point out, there's different businesses within there. There's big businesses, medium-sized businesses, small businesses. I mean, small business, and they're all important. They're all important to the economy. The issue of access to finance by small business, I just make a general point, is something that has been around for a very, very long time in policy circles. From APRA's point of view, the way that we think about it is, as we talked about before, in a neutral way. So if a bank is providing lending to a borrower, the important metric that we ask them to look at is risk, and we ask them to hold capital against that risk. So if you think about less risky lending, probably with a low LVR housing loan at one end, a low risk weight, and at the other end, you are probably talking about unsecured business loans with a high risk weight at the other end. That is typically the key requirement that we would have. Other than that, the bank is providing the funds, if they choose to, on commercial terms. So that's our particular perspective, noting that there are a lot of other issues that relate to access to small business and why they may or may not be able to get the funds. I
guess I take your point in terms of how you manage risk and how you think about it. I guess my question is, do we have that risk? Do we have the risk settings right? If we are in a situation where, we're, just even in the last, say, I think it is sort of 7-8 years, we're seeing credit growth growing for big businesses, for medium businesses, not for small businesses. And so, do we have the risk settings right for, the economy, balancing out, obviously the stability of the financial system, of course, but also for the dynamism and productivity of the country as well?
Yes, it's an important question, and it's a much broader question than APRA. So we, as I'm trying to articulate, is just looking at the prudential settings and how banks, if you like, lend depositors money through the economy and the requirements around that. But the issues I would put to you around small business, whether small business can access funding, are much broader issues, a much broader set of issues that go to policy making. So that I'm trying to give you is the perspective that we bring to the table.
I'll just add one small item that we're seeing, and I unfortunately don't have the breakdown to small business versus others, but we're actually seeing, as the very competitive environment is happening in the home loan market, you see a lot of NIM compression, the net interest margin compression and cashbacks, and we are seeing banks actually moving into business lending.
Sure.
And that's something that they are thinking about. And actually, we are actually not only are we seeing them move, but actually we're seeing some of the price adjustment as well. So they're actually making those choices. And I mean, we've said it a few times today, but we are trying to set a picture of the risk of sort of something that such that commercial organisations can make their choices. And we are seeing some such that suits their needs, moving in that direction. So that's a dynamic that is playing out.
Yeah, look, and I think, the charts I've seen saying, yeah, we are seeing more business lending, but we're not seeing it to the smaller end now, and that's the concern that's really the concern that I've got, as well as kind of the broader business lending environment. I think then just a question in terms of sort of regulation and how you think about regulation to balance risk. And at the same time to put some appropriate levels of burden on players. Interested firstly, I know that I think the Treasury's or the Treasurer's agreed on this financial services grid to sort of coordinate regulation. How, between the different regulators, how is that working so far?
So on that particular issue, that is very much in progress. So we're collaborating with the other regulators and the Treasury involved to put together the grid for later this year. So I think that is working in a very collaborative process, and we are very hopeful that that will provide more transparency and more coordination around the different sorts of regulation that is putting out in terms of the financial system. In terms of how APRA thinks about it, we do, as we've talked about, have a safety mandate, yes, on stability, yes, protection of depositors, insurers and superannuation members, but part of our mandate dictates that we do that and at the same time think about competition, contestability, efficiency of the system. So it's not safety only, it is safety and also thinking about these other issues and how we're thinking about those regulations. So then you go to, what does that mean? How does that translate in a real way? So if you think about our day-to-day activity, which is supervision, we've got 500 or so supervisors out there. We have a model, supervision model. It's the mainstay of how we're identifying risk around our entities. That model tiers all our entities from, if you like, tier one entities. You imagine a major bank or major insurer, complex, interconnected, certainly important from a stability point of view. There are a range of indicators that would have more intensive supervision, right down to, you could imagine a credit union or a very small insurer, not as interconnected, not as complex, would have much less intensive supervision. So that is hard-coded every day in terms of how we do our business. The other part that we have is the rules that our business are governed by. So when we are making policy, we're thinking very hard about, first of all, consulting with all our entities and the public on any issues, how that might affect competition, for example, and the effect of regulatory burden. We split large entities from small entities and often apply different sets of regulation to them. So examples of that might be, say, the capital stack, when Unquestionably Strong happened, we had 150 basis points on major banks, much less on smaller banks. So there are a range of standards where we split big from little, and data would be the other one, where I think we often hear from entities, it's just difficult when you're a small entity. It impacts on their ability to operate if you ask us for a lot of data. So we're quite prudent in who we're asking the data for, and we're actually culling some of our more ad hoc data requests. So I'll just stop there, see if that answers your question.
Well, look, I think it does partly go to the answer and I'm seeking, but it's one where, I've seen, there have been examples overseas where, for instance, there's an executive who's responsible for sort of deregulating while, there are others responsible, obviously, within the organisation, for the regulatory burden. I'm just, saying, look, how are we getting this balance right? And, whose responsibility is it to, is there a single person or someone's responsibility specifically to sort of say, are we, really pushing on that sort of competition contestability pieces at an appropriate level? How do you judge that?
So the four members of this table are judging that, and we're sitting on the main committees that look at supervision. We're sitting on the committee that is making policy decisions. We're sitting on the board and the exco. And I can tell you, when proposals are coming to us, we are asking the questions around, well, that's all very well on safety to do that. What is the effect on entities? How does that translate? Do we have to have a phased amount? Do we have to include everybody? Have we talked to the ACCC? Have we talked to our CFR colleagues? Those questions are being asked by the most senior people at this organisation.
And so, I guess the question is, are there metrics or KPIs that go to those questions that you look at? Because it's complicated questions. It's complicated to assess how well someone, an organisation is performing on that.
Yeah, so Mark.
Sorry, not on metrics, but on something else, if I could use an example to illuminate those. Because as John says, we senior people in this room are involved of this. I was the member overseeing our approach to the financial accountability regime. And as that was moving along, there were still some matters to be resolved in the minister rules. And one of the obligations, some might say burdens placed on industry under FAR, is they have to submit a lot of accountability maps, key responsibility lists, people's names against key responsibilities, quite a lot of material. And as I kind of observed in this process, it seemed to me that level of burden would change for smaller entities if the levels between core and enhanced entities were changed. So if you were a core entity, you had certain responsibilities. If you were an enhanced entity, you had much greater responsibilities. And the levels have been consulted on and set in an earlier period as the FAR took a while to pass. But as I came, if you like, a bit late to the party, we had a discussion here and we discussed this actually, suppose how it works. Members discussed, well, what if we suggested through our contacts at Treasury and up to the Minister that maybe if the levels were changed, the distinction between the levels were changed, that would reduce the burden on the smaller entities quite significantly. In the conversation, I then had a conversation with ASIC because we jointly administer the FAR, just check that they wouldn't feel they were losing anything significant by changing the levels, and we did indeed put that forward, and that was adopted as a change. So I think that just will give you a demonstration of how we are thinking about this all the time. I'm prepared to take things forward that reduce the burden and increase proportionality where we see an option to do so.
It would be helpful if we talked about where we do use proportionality and maybe where we don't as well.
Sure, I am conscious I'm running over time, so I don't, happy to, I'd like to, but I might go back to the chair and just check in because I'm, as the last question, so.
Or maybe if this can be the last question.
Sure, I appreciate it. It's a very complicated question and it's a difficult one, so I appreciate the engagement on it.
Yeah, so I think if we talk, just spin through. So Mark Kroll's given an example about where we've influenced government to set policy to consider in consideration of proportionality, and we would say that's in. The way we talk about it here is proportionality is in everything we do. So examples are bank stress testing this year. We only did the biggest 6 organisations, carved all of those out. The APRA standard, we set out a range of carve-outs for small organisations, giving them an additional time frame, as well as a 3-year implementation, supervisory plan, which means the smaller organisations are considered later. The interest rate risk in the banking book, that's actually got proportionality embedded, again, decided this year. The AT1 proposal, the hybrid proposal, that's in the system for consideration at the moment, very much has a big proportionality dimension, and so on. So there's a range of, they're the live decisions sort of this year, and I would say every single decision we've made this year relates to proportionality. Then we've made decisions where we've said, actually, the proportionality doesn't apply. And the one example that, well, the big feature that doesn't apply is cyber resilience. So that's an example where we've actually made an overt decision to say, and through our work where we've examined all entities in the system against our standard, our information security standard, CPS 234, we've made an assessment for all of them that we would examine them all and that would hold them to account. Because actually at the end of the day, it's the depositor of an individual in a small organisation and the depositor of a larger organisation, those depositors deserve the same protection and they're under the same risk. And so that's an example where we have decided that proportionality wouldn't be appropriate. But nearly in every other example, we have got a track record of actually asking that question. And we do that as a board, and it's a consistent part of our work.
I think your question also goes to how would we know? And so, that is difficult. I can tell you one thing we do is we do ask entities. We run a survey with entities and we ask them. And every single policy proposal of significance that we do, we consult with, and we come and talk to members of parliament like you and be accountable, and you should feel free to test that. So, I mean, all of those, I hope, give you some comfort that we're thinking about it and acting.
Thank you. Appreciate it. Thank you. And back to the chair. Thank you.
No, thanks very much, Ms. Bender, and thanks very much. There's obviously a lot of interest in your work on the part of the committee. Thank you for appearing today. The committee secretariat will contact you in relation to any matters arising out of today's hearing. You'll be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to any transcription errors. The committee will reconvene at 1:30 this afternoon for its public hearing with representatives of ASIC. I now declare this public hearing closed.